Hello and welcome to Market Domination. I'm Josh Lipton alongside Jared Blickery live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here is your headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
The streaming business grew 12% in the quarter, which is obviously a nice, healthy number for us. In addition to that, we're managing our spending much more efficiently. So we will go negative in Q3 a little bit more based on the timing of some cricket rights. But as we've indicated before, we'll be profitable in Q4, and we expect to build on that in 2025.
This is more about improving the costs for AI for Apple than it is necessarily a new product release leveraging artificial intelligence or things of that nature. So I think it's good news for Apple, but I don't know that I would necessarily buy the stock. I certainly wouldn't consider changing my hold rating on the news.
The economy is slowing, but certainly not so quickly that we're in for a hard landing. I think soft landing does look to be what's going to happen going forward. You see the labor market slowing, you see corporate profits doing actually okay, and you see the PMIs hovering around neutral. So it does look like a soft landing right now.
We've got 1 hour to go until the closing bell, and we're going to take a look at the major indices here, sponsored by Tasty Trade, and we can see a mixed market. Nasdaq, the sole index in the green, and the Russell 2000 leading the way. It's up about 0.3%. And let's just check on the intraday price action. Spent the entire day in the green, but well off the highs there. Not a lot of big movements in these indices. Also want to get a quick check of the bond market. We are seeing the 10-year Treasury note yield dip a little bit, down 3 basis points to 4.46%, critically below that 4.5% level, I should say. And here's your sector action. Materials flying high. That's up 1%, followed by real estate, staples, and utilities. Those are 3 defensive sectors. And then rounding out the top row, we got healthcare and industrials. To the downside, we got consumer discretionary, tech, and communication services. Those are the mega cap sectors. So let's take a quick look at the Nasdaq 100, where we can see, yes, a lot of these guys under pressure. Tesla and Amazon, the biggest constituents of consumer discretionary, both of those down. Tesla down about 3.5%. Apple up 0.4%, Alphabet up 1.5%, and just taking a quick look at some of the leaders here, you can see Chinese stocks, KWEB, that is by far and away the biggest loser of the day. And a quick look at that screen right here, and you can see a lot of red, not too much green there. Josh.
Thank you, Jared. Disney saw its streaming losses narrow in the second quarter as its entertainment apps, Disney Plus and Hulu, turned a profit for the first time. But the standout results in the quarter were overshadowed by the media giant's expectations for a softer third quarter for streaming. Here with more on this, we're joined now by S&P Global Ratings Media and Telecoms Managing Director Naveen Sarma and Yahoo Finance's very own Alexandra Canal. Naveen, it is good to have you on the show. So listen, Disney reported that stock is getting shelled in today's trade, Naveen. I'm just curious what you make of that reaction in the stock. You think it's an overreaction, Naveen, or no, it makes sense to you?
Oh, thank you for having me, first of all. I'm not an equity analyst, so I can't really comment on how the equity markets might be reacting to this. From the credit side, when we look at this name, what we saw was good execution in the quarter, and improvements both in the streaming side as well as on the advertising side. I'm not surprised at all that they gave a little bit of soft guidance for the parks for the third quarter. We saw that with Comcast. It's a question now of whether it's a function of consumers pulling back on their spending because they're being stressed economically or because they're finding more options to go to do things, cruises, travel. And so they may not necessarily be going to theme parks exclusively like they did a couple of years ago.
Yeah, Naveen, I want to pick up on that parks commentary that we heard on the call, because management did say that they're seeing a bit of a pullback compared to what we saw post-COVID when it comes to demand. Are you at all concerned that the parks business is not going to be able to keep up the momentum that we've seen heading into the end of the year, especially as you say, the consumers may be a bit squeezed?
Yeah, and look, parks are a cyclical business, and so you shouldn't be surprised to see if consumers come under pressure or we head into a recession. That consumers pull back on spending. But I think more importantly, what we saw in the last couple of years was tremendous demand for consumers to go to parks. They weren't traveling internationally because of COVID restrictions, and they had a lot of cash left over from a lot of the a lot of the savings that they built up over time because of COVID. Consumers are now spending a lot of money doing other things as well. They're traveling a lot more. They're going on cruises, which is what Comcast talked about. So I think there's a lot more options for consumers, and I think eventually you're going to see a normalization towards normal growth rates. Maybe this is the start of that.
Naveen, let's talk streaming specifically. So Disney says, reaches profitability in fiscal Q4. I'm just interested, Naveen, how you think long-term about how growth and profitability could look like for that streaming segment.
Sure. So getting to profitability for any of these legacy guys is, I think, really important. And Disney is, having launched ahead of everybody else and having greater scale than everybody else is getting to that point. Whether or not they can get up to the 20 or 25% margins that Netflix currently has, time will tell. There isn't a reason why they shouldn't, unless you consider the fact that they have a lot of sports programming, and that may pull down margins a bit. But there's nothing that shouldn't prevent these guys or any of the other players from getting to 20% margins, or at least the profitability. But it's a matter of scale, and Disney is ahead of everybody else in terms of that, and so that's why they're showing they break even already.
And part of that journey is going to be a crackdown on password sharing. That's something that CEO Bob Iger elaborated with on the call. We've also seen price hikes across the board here. Given the intense competition, the increases we've seen at other big streaming platforms, do you think that Disney has the pricing power to really compete here?
Well, what they're doing is interesting, right? They started off with just Disney Plus. They've put Hulu in as a tile, and they talked about putting in ESPN Plus as a tile later on this year. That gives them the ability to raise price. And so it's about content. It's also about the quality of content and the broad, the broad amount of content that they have. Look, by itself, Disney Plus is a great product. You layer in Hulu, you add the ability to go get additional customers, with R-rated programming, with general entertainment, and then you layer in sports. And sports, as we've seen, not just on television but also on streaming, is a great way to attract and retain customers, and also to be able to raise price. And so Disney seems to be aiming for a broader bundle of streaming services, and that should allow them to raise price.
Naveen, what do you make of the linear numbers we saw too? I'm just interested to take your take on traditional TV and where you think it heads from here. Are we bottoming here, Naveen?
Bottoming is a hard word. Look, we think that cord cutting will continue at kind of the pace that we've seen in the past year, which is about 6% if you include the virtual streamers into that calculation. We don't think that's going to abate. We'd like to see maybe there's a bottoming out in terms of cord cutting in the future, but we just don't see it at the moment, and so we're not forecasting that. I think on the advertising side, you've seen a number of companies report linear advertising revenue down 6%, 5 to 6%. I think that's probably where you're going to be going forward. And so the question that all of these companies now need to address is, can they grow their streaming revenues, advertising, faster than the linear advertising declines? And what we saw in the quarter was Disney was able to do that if you include sports as well.
Naveen, it was great to have you today. Thanks for helping us kick off the show.
Thank you very much for having me.
Sticking with the media giant as Disney's turnaround efforts take shape and eyes profitability with its combined streaming business, our next guest is feeling optimistic in the path forward for the company. Joining us to discuss is Robert Schein, Blanky Schein Wealth Management Chief Investment Officer and also a shareholder of Disney. So Robert, let's start there. Disney reports investors clearly disappointed, Robert, but you're a shareholder. So let's start with your response and reaction to the report, Robert.
Yeah, we believe if you look at market action today on Disney stock, it's overreact. So what that does is present an opportunity. If you're a long-term shareholder for Disney, you can average in year to date. We're still up significantly, especially since October lows. But moving forward, the quarter was solid ultimately, and that's what we're looking for. So we know that management is focused both on the top and bottom line. Narrow miss on the top line, bottom line, they made it. But moving forward, I think the biggest disappointment, why the movement is down today, is sort of the guidance wasn't what Wall Street was anticipating or looking for. So that was disappointing in the future guide.
And Robert, I'm curious to get your opinion on this because you voted for Nelson Peltz in that proxy fight battle that didn't come to fruition. Disney was able to successfully fend off Peltz. Does this earnings report give you the confidence that the current board has things handled, or because of the fact that we have that softer guidance and there seems to be some overhanging headwinds here, do you think that this board needs another person like Peltz? And do you anticipate more proxy battles and fights in the future?
You know, at the same time, I do believe that last quarter's drama is behind sort of the Disney management team, but it's not out of the picture, right? It's that sort of villain that could potentially re-present itself, but not a villain in a bad way, in a great way, especially if you're a Disney shareholder. By that, I mean, you have management's focus on basically profitability. They're basically shareholder friendly right now. They're focused on quality sort of family content moving forward and executing on that. If you look at the entertainment pipeline for the back end of this year, it's solid. 2025 and 2026, all the sequels and all of the great new content, as well as the investment into the theme parks, over $60 billion. And don't forget, last quarter, they also announced, 50% boost to their dividend, $3 billion buyback. So I wouldn't be surprised if they're out there doing that today. Obviously, the direct to consumer is a story where that became profitable, as well as in terms of the streaming. I think the streaming, as we've seen others in that world, has scalability. So again, Disney is in a category of one. There's really no competition if you look at what their library is, and they have $1 billion after $1 billion opportunity just to execute. They just have to keep focused on the financials, and they've already announced, $7 billion. They're on track to keep that $7 billion sort of cost-cutting initiative across the board. So by that, as long as they're focused on being shareholder friendly and minding sort of the highest and best uses of capital, but yeah, we have confidence moving forward.
Robert, so Disney's CFO, Hugh Johnston, was on Yahoo Finance this morning. He talked about that bruising proxy fight. Let's take a listen.
It was a bit of a distraction for a couple of members of the senior team. That said, look, the management team under Bob is focused on creating value for all the shareholders, not just one or two of the ones that tend to be a little bit more talkative. And as long as we keep our eye on delivering value for all the shareholders, I think we'll be in a terrific spot going forward.
All right, so there's Hugh Johnston calling it a bit of a distraction there, Robert. I am curious, though, as a shareholder, why you wanted Nelson Peltz on that board, Robert? Why you voted him? What were you kind of hoping he would bring? What levers did you think he was going to pull?
Either way, it was a win-win, right? He basically got management's attention. Whether he was physically in the room moving forward, he's mentally in the room moving forward. And really, again, they're in a category of one as it relates to what Disney has as a product and a service and an entertainment business. And then their wonderful storytelling, sort of, lifetime generational. They just have the ability to capture that moving forward. And I think they were just going in too many different directions. And now that they can focus on a sort of a keen focus on a great way, it doesn't mean that Nelson Peltz is not sort of in the wings. But, from, below $100, I always thought, Disney below 100 is a generational buy. Now you got that magic of opportunity being down 10% today. Moving forward, I believe wholeheartedly management's going to execute, and you're going to see, it's down 50% from its 52-week high. So there's a lot of shareholder value still to be realized. Management is not out of the woods. They still have a lot of work to do. And again, they're going to get called down to the principal's office, whether it's Nelson Peltz today or somebody else, in the shareholder world tomorrow, that basically believes that they could do a lot better. And the reality is they can, and that's why there's tremendous value. Both, it doesn't matter who you're voting for. Moving forward, there's value to be had.
So you would consider this stock decline today, we're set to close down nearly 10%, as a buying opportunity? Would you say that, and why?
Yeah, again, direct-to-consumer streaming was a very positive, unexpectedly, so that was better than expected. The cost cutting is still taking an effect, so that's helping all the numbers. The uncertainty component, and that's the one thing that we all have to see if it's just a story outside of Disney moving forward, is the consumer, right? They basically said, hey, listen, that's where everyone got spooked right now, and say, oh, wait, consumer discretionary. Is it a kitchen table economic, personal to what's happening out there because the economy is so tough, inflation, so on and so forth. So does that become a bigger issue, i.e. impacting Disney's theme park, which is their biggest revenue source? So that is the concern that sort of Wall Street's looking towards right now. And then the CFO this morning basically said, hey, listen, I'm going to give you conservative guidance. Conservative guidance from a management team is always positive moving forward because they always want to manage expectations low and set the bar low so they have success moving forward. So,
all right. Our thanks to Robert and Ali both for joining us today. Great chat. Thank you both.
thank you.
We are just getting started here on Market Domination. Coming up, our coverage from the Milken Conference continues. We're going to hear from former Speaker of the House, Paul Ryan, at 3:30 p.m. and the CEO of Whole Foods in our 4 p.m. hour. Plus, Apple's iPad is getting a major upgrade. The tech giant unveiling its latest version of a tablet in an event today. Our own Dan Howley is bringing us all those details. And TikTok is suing the U.S. over the government's recently passed divest or ban law. More on what this all means for the app's future. That's on the other side. With economic growth in the first quarter slowing and a sign of a cooling labor market in April jobs report, our next guest thinks both of these things put the Fed in prime position to ease rates. For more, we're bringing in Omar Aguilar, CEO and CIO at Schwab Asset Management. Omar, it's good to have you on the show. So the Fed, you think, is in position here possibly to ease. Just walk us through the reasons, Omar, and when do you think they could start cutting? July, September, December? You know, what would be the timetable, you think?
Yes, thank you for having me. And, the last week was so relevant for the Federal Reserve in terms of monetary policy, between their meeting and also the labor report that we got on Friday. clearly puts them back into the driver's seat of having different options on the table. Not too long ago, there was still the discussion about the potential for a rate hike. I think Chair Powell, clearly made it clear that that was not in the agenda anymore, and the next move most likely was going to be a cut. Our estimate based on, what we see the economy is slowing down, as well as the inflation finally getting to the point where the Fed might look as options, put us into 1 or 2 rate cuts for this year, most likely starting, more in the fall, more like in the September, with still slight probability to do it in July. But certainly, I think the data on inflation will have to give plenty of reasons for the Fed to make that move in July. Most likely will be, later in the year.
And Omar, let's talk about what sectors you like. Just by your notes, I know you like cyclical sectors, and I want to show the audience a Wi-Fi Interactive where I have the sector action for the S&P 500 year to date. And among the top entrants here are energy and financials, number 2 and number 4, up 11% and up 9%. What do you like about cyclicals here?
Well, we have been working with our clients here at Schwab on getting this slow rotation out of the growthy names that we had in last year into more the cyclical early part of the cycle. The whole premise behind, the work that we have done here is related to what we believe has been a rolling recession followed by a rolling recovery in the economy. And what that does is basically portray the behavior of markets more in the early part of the recovery. We're not necessarily yet at the economy level, because this cycle has been kind of strange, because we're still discussing soft landing, we're still discussing economic slowdown, we're still discussing inflation going down, but the market seems to be going towards those areas. And in that early part of the economic cycle, when we're in the recovery, given that rolling, component, we tend to favor areas in cyclicals that have worked well so far, financials, materials, energy, that tend to do well in the early part of the cycle. And so far, has actually worked. It's probably just the last few months where things are starting to look that way.
Omar, I'm interested, is earnings season profit growth coming in better than expected? What do you see for corporate profit growth, Omar, for the rest of the year?
Well, it's kind of interesting. I think we have gone through these, and there's 2 components. One is we continue to see the strength in corporations. We continue to see that component of, corporations staying in places. And it's a little bit, 2 sides of the story. Companies that continue to spend their capital, companies that have strong balance sheets doing very well, companies that rely on pricing passed through investors are not doing as well. And I think that's a little bit, you can see some of the earnings reporting areas where the pricing power used to be an easy pass to the consumer. Because of this slowdown on consumption, we can see that earnings, being slightly different across those sectors. But overall, for the market, we see strength in the corporates being very strong, in this quarter, continuation into the next quarter. Now, the interesting thing about this is the reaction of the market seems to be focusing more on revenue and less of earnings, strength. So earnings beats have been very good, close to 80% for the market so far, but the beat on earnings, on revenue, hasn't been as strong, and the market seems to be focusing more on those companies that tend to beat revenue as opposed to just earnings.
All right, we're going to take note of that. We have to leave it there. Always appreciate you stopping by, Omar Aguilar. Now, TikTok is suing the United States government over the potential ban of the app in the U.S. The social media platform claiming that a ban violates First Amendment rights. Here with more details is Yahoo Finance's Alexis Keenan. Alexis, what's going on here?
Yeah, so we were expecting this lawsuit, right? Not necessarily today, but we were seeing it coming. We know that ByteDance TikTok has objected on free speech grounds, saying that the U.S. should not be able to just pass a divest or ban law, and that's what President Biden signed into law. And if it took effect, it would, by January 19th, 2025, be gone if the company was not put into U.S. hands, U.S. ownership. Now, the First Amendment speech argument is there. TikTok says it's an editor, it's a publisher, it has its own free speech rights under the U.S. Constitution. Well, that's going to be tested here. We're not sure. They also say that their users' free speech speech rights under the First Amendment are being compromised here. But look, you can't vicariously assert constitutional rights. That claim is likely going to have to come from the users themselves filing their own lawsuit. Also, there are arguments in here for violations of bills of attainder. That's laws that punish entities, people without a trial. Also, equal protection argument in here where the U.S., disadvantages a party specifically, and TikTok, ByteDance go into detail about how the U.S. is singling out them particularly to make this law. But look, the U.S. disadvantages foreign companies all the time. All you have to do is look at tariffs to know that. Also, finally, there's a Fifth Amendment argument here. It's a takings clause argument where they're saying that the government is taking away private property without just compensation. Easy fix there, maybe. You can compensate these parties in order to alleviate that problem. But look, there would probably be antitrust concerns too if there had to be a divestment of a TikTok to a U.S. entity, because who are the social media companies, who are the tech companies that could likely buy it? Those that would, I think, raise some eyebrows at the FTC and the DOJ if they were to take that entity under their ownership. So these are claims to be tested. The main question will be, how far is the First Amendment going to go to protect the free speech of a foreign company? A lot of times, a lot of cases, we have Citizens United, we have cases that have established in that case that corporations have a free speech right to make campaign contributions. U.S. companies, though. So this will be a novel idea that is tested here. It's in the D.C. District Court, federal court there, but this is the complaint as it's laid out by the company.
All right, Alexis, we'll keep watching. Thank you. Coming up, our coverage of the Milken Conference continues. We're going to hear from former Speaker of the House, Paul Ryan, on the other side of the break.
the Milken Institute's Global Conference. 6 months out, I think we got that count right from the presidential election. Politics certainly in focus, as is economic policy. And we've got Paul Ryan here to talk about that. He is partner at Solomir Capital, vice chairman of Teneo, and of course, the former House Speaker. Good to have you on set today.
Thanks for having me. Nice to see you.
Got to start with what's playing out in politics, and we'll get to the economics in just a bit. Right now, you're familiar with the discourse in Washington.
Yes.
And we've got a House Speaker who is potentially facing another ouster. I'm just curious what you make of the discourse that's happening within the GOP right now.
Yeah, well, with a tight margin like this, you have a few nihilists who are not interested in seeing their team succeed, but building a brand for themselves. This is the kind of behavior you're going to get. If Marjorie does this, I don't know if she's done it or not, maybe some news broke, but she's not going to succeed because Akeem, rightfully so, for the institution said we're gonna table this, so it won't succeed. But it's just a nihilistic approach that some of these members are taking. It makes the place ungovernable. Knowing this was going to cost him potentially his job, Mike Johnson still did the right thing. So I've always said you can't be good at these jobs unless you're willing to lose them. You fight for the institution, do what you think is right. That's exactly what Mike Johnson's done. He's new to the job, but he's scaled the learning curve pretty fast. So I'm very proud of him. He's a smart and decent man who tried his best to bring his team around, irrespective of the fact that he knew they were going to come after his job and threaten him like they just did his predecessor. He went forward anyway and did the right thing and passed this package. So that's what leadership looks like. It may cost him his job next term, but he did it anyway. And that's the kind of person. That's to me, that's heartening. Our institutions still work. We have leaders who are stepping up and doing the right thing. Not every time, but in this case, that's what happened. And shame on people who think that they should vacate a speaker for a policy disagreement, for simply doing his job.
How is this dysfunction? You speak to a lot of leaders, a lot of CEOs. How is this dysfunction impacting how they plan their businesses?
Yeah, that's the problem. It adds to the uncertainty tax. There's a lot of uncertainty about who's going to be president. There's a lot of uncertainty about what the tax code is going to look like after 2025. This creates a lot more of that uncertainty. In this case, it's are we supporting our allies? What's the war in Ukraine going to look like? That affects agricultural markets. That affects a lot of things with respect to supporting Japan and Israel. So just getting that thing through took 4 or 5 months. That creates a lot of uncertainty. So it just adds to that uncertainty tax.
One of the things that's we've been hearing a lot on the ground here are concerns around the debt levels globally, not just in the U.S. Looking at the numbers in the U.S., IMF projecting U.S. debt to GDP ratio to go up to 134% by the end of this decade. We're at more than 120%
then it keeps going up to about 200%.
Why do you think that's not a bigger issue in the election?
That's the best question you can ask, I think. What frustrates me about this is both of these guys running for president, Trump and Biden, are both promising they're not going to do anything about this. Not only are they promising they're not going to do anything about this, they're demagoguing those who are offering solutions. They're running against these people, trying to scare seniors into thinking, I'm going to go after these people who are proposing reforms. If you don't reform this debt problem, what I'm trying to say is you have to reform the entitlement programs to prevent their insolvency, to prevent their bankruptcy. Medicare and Social Security go bankrupt within a decade, and that hurts current seniors. And proposing to do nothing about that, like Biden and Trump are currently doing, hurts those seniors. And so leaders in Congress, they're both bipartisan. There are people on the Democrat and Republican side saying, we got to fix this, we got to do something about this. And our two guys running for president are demagoguing it. That to me is very frustrating. It's kind of scary because we're walking ourselves into a very predictable crisis, a debt crisis. And that's bad for everybody. Everybody gets hurt under a debt crisis. The economy suffers, seniors suffer, people living on the safety net suffer. So the smart thing to do is, knowing bankruptcy is coming, get over this. Pass reforms that are phased in, that don't affect current seniors, to stop this from ever happening. That's what a serious government would do. That's what serious politics and serious politicians would do. It's not what we have right now.
Then I was going to say, is Warren Buffett then right that to solve this, or partially solve it, you have to raise taxes?
Look, everybody wants us to say, yeah, you can just fix this with that. You can't tax your way out of this problem. The numbers are just so big. You can't cut the Pentagon, you can't raise a bunch of taxes and come close to solving this problem. The driver of the debt are these entitlement programs, namely Medicare, Medicaid, Social Security. Now, the good news in all of this is, number one, it's totally within our control as a country to solve this. Number two, you can solve these problems without affecting current seniors. Number three, we've learned a lot since we started these programs in the 30s and the 60s and the 20th centuries on how better to deliver these benefits. We got to modernize these programs so the next generation, our generation, I'm the next generation, you guys are younger than me, the next generation can still have a good safety net, can still have health and retirement security, but you just got to reform these programs on a go-forward basis to do that. That can be done. Raising taxes doesn't even come close to solving this problem. Can you get a higher revenue line without doing a lot of damage to the economy? Yeah, I think you can, but I think that's more of a tax reform question. But if you just do what Biden's proposing, have effectively almost a 50% capital gains tax, hurt businesses like small businesses with a giant tax increase, that's going to kill economic growth. So here's the thing I'd say is, you can't solve this without a growing economy. And so if you're going to play with taxes, you got to do it in a way that you make sure you keep the economy growing and don't take your eye off the ball, which is spending, and it's the way these entitlement programs are designed. And you can fix them on a go-forward basis without affecting current seniors if you start soon. You can dodge the debt crisis. It's the most predictable economic crisis we will have ever had in this country. And frankly, we're not doing anything about it. That's really disconcerting.
With that said, there's questions about what Trump policy in a second term could look like on taxes. Obviously, potential extension of the Trump
which
tax
I'm
cuts.
in favor of. I think that's a good thing.
You've talked about this being a big legislative achievement. Would you be in favor of allowing some aspects of that act to expire in order to rein in the debt?
old me is saying don't negotiate through the media. I'm not in a position to negotiate. I'm not in government
You're
anymore.
not in government anymore.
I'm not in government anymore. So let's look at what expires. It's the individual side of the code. It's not the corporate side of the code. So it's all those tax rates on families. You raise those tax rates, you're going to hurt economic growth. I could see a deal where the top rate goes back up to 39.6 from 37, but it's kind of a rounding error on the numbers. But I can't imagine either Biden or Trump in divided government, which I think we're going to have, allowing that to expire. The thing that is not getting covered much is something we call Section 199A. It's kind of an obscure provision, but when we lowered corporate tax rates to be commensurate with the rest of the world, so we be globally competitive, which is working, we also lowered the tax rates on what we call pass-throughs. Subchapter S corporations, sole proprietors, limited liability corporations. That's 80% of American businesses. They got a corresponding rate decrease so that they were on par with corporations. Think of the person in Janesville, Wisconsin, who owns the Ace Hardware, competing against Home Depot. Do we want their tax rates to go back above 40% when Home Depot's at 21%? No. I don't think we want to let that happen. That's what happens if you let Section 199A expire, which Biden's proposing to do. I think that's devastating to small businesses and medium-sized businesses, really bad for economic growth. I think they need to extend that. Frankly, I think they will extend it, because raising taxes in all these small businesses across America is not good economics.
I was watching your panel yesterday talking about the state of where the election is. I'm going to read back some of the things you said. Obviously, you said, I'm against Biden on policy, against Trump on character. Trump bad on NATO, bad on alliances, bad on Europe, bad on trade. You've been very clear about your opposition to President Trump. With that said, the options are Trump and Biden right now.
Go ahead.
Is there a vote for Trump in here if given a choice?
Not from me. I understand the binary argument. It's a reasonable argument. I just don't agree with that argument. Character is too important to me. And it's a job that requires the kind of character that he just doesn't have. Having said that, I really disagree with Biden on policy. I wrote in a Republican the last time. I'm going to write in a Republican this time.
You're going to write in a Republican?
I don't know who yet.
On Trump and the economy, we've had a lot of conversations here. More isolationism by Trump potentially in the second round. 60% tariffs. Is Trump round two good for the economy, the U.S. economy?
Well, cross-border tariffs aren't good for the economy. Fighting China is necessary, and both of these guys are going to fight China. I think, frankly, that's fairly bipartisan. If you look at the House committee between Raj Krishnamurthy and Mike Gallagher, they put together a Venn diagram of bipartisan China policy. So I think either administration is going to be effective, is going to be committed to fighting China. I think 10% tariff across the board is a really, really bad economic policy.
What about 60%?
I think it's bad economics.
That's just...
Well, that's on China. That's on China. But 10% across the board is just 10% tax on American consumers, making our businesses less competitive. So I don't think that's good policy. But Biden's proposing this massive tax increase on medium and small-sized businesses as well. So now, is there any wonder I don't like either of these guys? So I think they're both bad for the economy. I would argue Trump is probably better. Look, I'm a person saying I'm not for Trump. His economics are better than Biden's. If you have to ask me which one I like better, Trump's because he's better on taxes. I don't like a lot of the tariffs. That can be done by a president, but I think he'll be better on regulations and taxes. The problem with Biden is he went left. He wasn't the moderate, the swing state voters in Wisconsin thought they were getting. They got this progressive. He's got ideologues in the executive agencies, really bad regulations, killing energy production, proposing big tax increases. So that's not a very attractive economic agenda either.
Former House Speaker Paul Ryan, we'll have to have you back on many times before the election.
You were nice to see you again.
Thank you so much.
The Biden administration reportedly revoked export licenses that allow Intel and Qualcomm to supply China's Huawei with semiconductors. This is according to the Financial Times, and the move affects the supply of chips for laptop, computers, and mobile phones. And Josh, I'm going to chart this on the Wi-Fi Interactive real quick, but we're not seeing a lot of big movements here. Here's our semiconductor. It looks like a lot of red, but this was the way it was until moments ago. And here's Qualcomm, just got a little bit of a dip in the red. It was already just slightly below the unchanged there. And finally, here is Intel, barely a reaction, already on the way down.
Yeah, I mean, obviously part, Jared, of this kind of broader push by the Biden administration restricting chip sales to China. China would like to be a global tech powerhouse. The United States government would prefer they not be. China is a competitor. China is an adversary. And of course, with Huawei in particular, blacklisted by the U.S. government. And remember, Qualcomm has been pretty clear about this. They've told investors, listen, we don't sell our latest and greatest phone parts to Huawei. We're obviously compliant and in line with current restrictions, but a story to watch for sure. Moving on, Apple debuting its latest lineup of iPads during a virtual launch event today, and Yahoo Finance's very own Dan Howley is here with all the details.
God, yes. Yeah, I mean, the big news here, obviously, the two new iPads, the iPad Air getting an M2 chip, and the iPad Pro getting a new OLED display. Big news, big upgrades for sure. But honestly, I think the standout was the M4 chip that Apple debuted. That's a picture that I took. So's that. The M4 chip really is the big news here. Only because it serves as almost an appetizer for what's to come as far as Apple's AI capabilities. And that means, look, they've been putting AI capabilities, these neural processors or neural engines, into their chips since 2017. This isn't something that's new. But if you listen to the event and the way they talked about the AI capabilities of the M4, there was a change. They started talking about trillions of operations per second, or TOPS. That's not something that Apple usually talks about. That's something that NVIDIA talks about, that Qualcomm, Intel, AMD, they'll talk about as far as their new chips go and AI. And so they talked about how this is going to enable certain applications, how it's going to allow for future AI apps. They didn't go into specifics as to what they're offering at all. It was just about really the hardware here. But if you look and take a step back, it's clearly them setting up what's going to happen at WWDC next month. And I think that's the big takeaway from this.
Dan, a question about AI. You said they started describing it in detail, and I'm just thinking, I didn't have a chance to watch this particular presentation, but Apple in the past is famous for describing its products in loving detail, exquisite detail. Do you think this is going along those lines, that this is just setting AI to be potentially at least a part of the next big thing?
Yeah, look, I think one of the things about Apple is they famously don't like to talk about underpinning technology, right? They like to talk about how they have a specific type of technology that's important. So they talked about the OLED displays today, but then they started talking about how it's a type of retina display or XDR retina display. So they like to talk about that more than the underlying technology. I think when it comes to AI, they're going to hit some of the buzzwords in AI, but then what they're going to do is, I think, offer a more nuanced explanation as to how they're going to use AI or how app developers will use AI. Right now, when you look at something like Intel or AMD or Qualcomm, when it comes to consumers, at least, generative AI is basically ChatGPT and Microsoft's Copilot, things like that, Google search getting AI. But on a device, it's not really something that gets you to want to buy it, right? Apple is all about getting you to buy its devices. So they're going to have to push hard on how their software is going to enable and their hardware is going to enable generative AI and make it worth purchasing.
Yep. Dan, we'll keep watching. Thank you, sir. Coming up, earnings season is well underway. What we have learned so far and how should you play it in your portfolio? We'll discuss that on the other side. It's been a solid first quarter. The majority of S&P 500 companies have exceeded the street's expectations thus far this earnings season, according to data from FactSet. Many of the biggest names in tech have already delivered, but of course more results are on deck in the weeks to come, including Mag 7 heavyweight NVIDIA. We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and we're joined now by Scott Ladner, Horizon Investments Chief Investment Officer, and Jay Woods, Freedom Capital Markets Chief Global Strategist. Guys, welcome both of you to the show. Scott, maybe we'll start with you. Just, interested, Scott, got a big picture as you kind of made your way through this earnings season. You saw a lot of reports, you listened to a lot of conference calls. What have been, Scott, so far kind of your big takeaways, lessons learned for you from this season?
Look, I mean, the big takeaways are companies are doing really, really well. So we're back to solid earnings growth in the United States. We're going to be printing like 10, 11% kind of, annualized growth rates. And the other big thing we've learned is not necessarily from earnings season, but we've definitely learned the last couple of weeks, topping rates is done. So, like just big picture wise, you don't tend to get really bad markets if you have earnings growth that's in the double digits and rates are capped. That's the kind of situation we have right now.
Jay, comments on earnings here?
Yeah, earnings season has been phenomenal. It just hasn't been that catalyst to take us that next leg higher. We're coming off back-to-back quarters of 10% gains. We were due for that 5% correction. We got it, and now we're churning higher. I like the market's resiliency. The Fed and the 10-year, that's what's driving the bus right now. And the 10-year spiked to 4.7%. It's come back in.
Yeah, below 4.5.
Yeah, I know. And this 4.5 is fantastic, but this higher for longer narrative, we're digesting it. This is the new normal. Us older folks, we're used to, higher rates, but the market is digesting it. And what we're missing now is that catalyst. What's going to take us higher? Is it going to be a cut finally? If we get softer data in the CPI, PPI coming up, maybe we'll get more, excited that cut can come. But as you mentioned, NVIDIA, I think that's the one we're watching for. If we can see that take us above 950, that next leg higher, it could take the market up for another nice ride.
So Scott, as a question to you then, what do you think the catalyst is? You think it's NVIDIA, or could it be, Scott, listen, if you've got decent economy, decent earnings, if Jay Powell just told you a hike isn't coming, is that enough? Is that a catalyst?
Well, I mean, it could be, because we're sort of done with the Fed, I think. I mean, like, if we've gotten all the inflation data we got in the first quarter, that was, like, frankly, pretty hot and not great from the Fed standpoint. We got all that, and he comes out and says, we're good. We're just going to let time take care of it. Like, that's kind of tells you everything you know about the Fed. So, like, they are basically out of play at this point. So catalyst-wise, I'm not sure they're going to be the thing that does it. NVIDIA definitely could. Some more AI kind of news definitely could. We could actually get, is it possible we get good geopolitical risk coming in? Like, could we get something out of Russia, Ukraine? Could we get some settlements out of the Middle East? Like, we could actually have some positive catalysts from the geopolitical standpoint. But I don't see anything huge on the horizon, frankly. I mean, I think this is going to be a little bit of a grinder, probably a little bit of a grinder for the next few months. But grinding up rather than down.
Jay, you are a market technician. I want to ask your opinion about the charts. We got all three majors now solidly above the 50-day. Kind of a big hurdle there. Where do you think we're going from here?
Yeah, this is a head-scratching rally. I didn't think we would make back that 5% loss as quickly as we did. Coming into this week, we were all watching the 50-day in the Dow, in the S&P 500. We got above it. The week is still not over. Let's see how we finish. We're getting a little bit of a reversal today, especially in the Nasdaq. And I agree. I think we're going to chop for a little bit. To make that next leg higher, that new high, I don't see it. And then one thing about Powell that was interesting, he basically said that inflation is transitory, but he didn't use the word this time, shockingly enough.
Oh, he learned there.
Yeah, he definitely learned. So it was interesting. So I think we will chop continually, but individual earnings, they're not enough to take that next leg higher. Amazon made a new high today. It's on the verge of a major breakout. If you look at it on a weekly chart, it hasn't taken us there. Alphabet did. Microsoft didn't on solid earnings. So we're not seeing that euphoria. We're not seeing that tailwind we want to see. But if we can get a little more data behind us where inflation is finally cooling, and maybe it's not transitory and it's going back the way they saw it trending at the end of last year, then we'll be ready to rally, June, July, August. We'll see. August, September, let's not go too far ahead of ourselves. Those are the trickiest months of the year.
So Scott, back to your point being like, listen, maybe over the next few months we kind of grind here, but you likely say, listen, probably grinding higher, not lower. If that's the case, Scott, where in the market, what looks attractive to you? Where are the opportunities by sector?
Yeah, I mean, like sector-wise, frankly, it's kind of a little bit boring. We were just talking before the segment, like kind of like tech, kind of like communications, sort of like the stuff that everybody else likes right now, which isn't the super, not the most interesting. But again, this trade that we're in right now is the best thing we've had since the mid-90s, since the PC internet stuff. Like, that went on for a few years, and it was kind of like a little bit boring and obvious too back then.
And you don't think all the good news is priced in, obviously?
Oh no, definitely not. I mean, because we don't know what all the good news is. Like, the good news may be starting to get priced in the chips and like kind of the picks, picks on the hardware kind of thing. But the next leg of this of the rally for AI related things is going to be like, which companies are actually using this and which ones are just kind of like paying to the lip service. So
meaning where is it really generating real meaningful profit versus marketing fluff?
Exactly. Yeah. I mean, like, what companies are actually using to drive productivity? Revenue per worker is one way to measure productivity. Revenue per worker in the United States has been basically flat for 25 years. Like that's kind of crazy to think about, but it's basically flat on a real basis. The last time we had meaningful growth in that metric was in the mid 90s, and I think we're probably getting back to that. But figuring out which companies and which sectors are going to actually generate that productivity growth, I think is probably going to be the next leg. But we are still got to figure that part out.
Since we're talking about parallels with the mid-1990s, just want to bring up that's when the Fed achieved that mythical soft landing. It was able to proactively make some cuts, and the market didn't crash, didn't freak out, and also inflation didn't get away from it. I think that's what people are betting on this time. But the other scenario, what happened at the end of the dot-com boom and at the beginning of the global financial crisis, was the Fed had to cut aggressively because the handwriting was on the wall. We're heading for recession, and that's when things get ugly. So what does that look like to you? If the Fed had to cut aggressively, what sets that up?
I mean, exactly what you just said. It's recession on the horizon. So, we don't want to see 2% rates anymore. Like, I mean, if you've seen a 2 handle on the 10-year, like, we're in trouble, right? So, like, we hope we see a 3 handle. Like high 3s would be a great place to land. My guess is probably going to be in the mid to low 4s or something like that. But regardless, anywhere between 3 and 5, you're okay. Right? I mean, above 5, you got inflation problems. Below 3, you have growth problems. So anyway, and anywhere in that middle is like probably going to be a pretty good spot. Because like you said, like those mid-90s, that's kind of where we settled out, right?
Yep. All right, Scott, Jay, thank you guys both for joining the show today. Appreciate it. That was great. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime. That is the closing bell on Wall Street, and now it is market domination over time. Jared Blickery is getting you up to speed on the action from today's trade, sponsored by Tasty Trade.
Thank you. And let's take a look at the Wi-Fi Interactive, where we have a mixed market today, although we're not seeing any huge moves. The Russell 2000, the putative leader, up about 0.2%. The Nasdaq just barely in the red, and the S&P and the Dow just a little bit in the green there. And just want to take a quick look at the bond market. We did see the 10-year down 3 basis points to 4.46%. And in sector news, we have a couple sectors in the red. That's consumer discretionary. Then we have tech and also energy. But in the green, we have materials leading the way, up 1%. Staples and utilities and real estate following those, each of those up more than 1%. And I also want to take a look at meme stocks. Now, you're seeing some red on your screen, especially to the left, where we have Coinbase down 5.5%, Palantir down 15% off earnings, and Carvana down 5%. But check out the 4-day total here. These have been jumping in prior days. And if I sort by performance, you're going to see a lot more green than red. GameStop up almost 50%, costs up 42%, Carvana up 34%. So the way I'm interpreting this is it's risk on. And you might say these are the laggards catching up, but these meme stocks have been a staple of the bull market that the last leg going back to October of last year, Josh.
All right, Jared, joining us now with today's trading day takeaways. Yahoo Finance's Alec now. Alec.
Yeah, so, a bit of a mixed picture here with the Nasdaq closing lower today, but leading up to this trading day, we had pretty much a rally on our hands. Markets were up pretty steadily throughout the month of May, and this followed a pretty significant downtick that we saw in April. Now, April was the worst month of the year for stocks so far. We'll see if we can continue this momentum throughout May, but it's been interesting to track the performance of these major indexes as we've gotten this slew of economic data, and they all seem to paint a little bit of a different story. Obviously, the jobs report that we got on Friday coming in softer than expected, that really fueled hopes for investors that we could see a rate cut come as soon as this summer. But it's really been earnings that have kept markets afloat. Our markets reporter Josh Schaefer pointed out that with 80% of the companies in the S&P 500 reporting, the benchmark index is pacing for 5% growth in Q1 earnings per share. And this is the biggest year-over-year increase since the second quarter of 2022. So this has been a narrative that strategists have really been stressing here. It'll be interesting to see if that momentum can continue through the quarters to come.
Yeah, it's been really interesting to track that. We're coming out of an earnings recession. That's where we've had multiple periods of earnings, instead of earnings growth, earnings contraction. So we're on the upswing there. And a lot of the arguments that I'm hearing investors make for the bullish case is that, all right, you look at earnings, EPS strong, projections for earnings are strong, and then you have the interest rate situation. We had a surge in interest rates in the 10-year, but it's moderated, and the direction has been down. So these are all tailwinds, and we haven't seen equities perform outstandingly. There's been fits and starts. We had a little bit of a stumble today, but nevertheless, it's been 2 steps forward and 1 step back. Just wondering what you're seeing there.
Yeah, and Jared, to your point of how we have a lot of tailwinds going right now, I think in regards to earnings season, you can look at a company like Disney, for example. You could say, all right, well, look at the Disney stock down nearly 10% today. But I think throughout this earnings season, there's been this expectation that you can't just have a beat. You need to have a beat and a raise. And we saw with Disney, they pointed to some softer guidance in the third quarter, and the stock was punished for that. They also warned of inflation. They warned of higher prices, potentially hinting that the consumer might be squeezed right now, and that could impact demand. And that's something that we've heard from other consumer-facing brands like McDonald's, PepsiCo, Starbucks. Remember that disastrous quarter that we just got. And, this inflation story, it's going to play out throughout the rest of this year. And, the cycle continues, right? Inflation impacts earnings, it impacts the Fed policy, yields, et cetera. And this is just where we're at right now. And I think that's really been the theme for earnings season. So we'll see how this all affects.
You mentioned Disney. Now I'm looking at the Wi-Fi Interactive. I have the Dow heat map up, and Disney's kind of a sore thumb. You can see down 9.52%. I'll just pull up a year-to-date chart. That's today. What do you think about Disney earnings? You track this stock closely.
Yeah, I was a bit surprised to see this intensive a reaction to the earnings report because we didn't really get any major changes in guidance. The company still said it expects streaming profitability by the fourth fourth quarter. But I think the fact that we did see a bit of that softer, choppier guidance in the current quarter, that's something that had investors concerned. I mean, this was a stock that prior to the drop that we saw today had been up about 30% year to date. So I do think there would have been some sort of a correction to come, if not today. So perhaps a bit of a breather there. And we spoke to some analysts earlier today who said that perhaps this is a buying opportunity for the stock. So overall, I think Disney has all the right components to move forward. Of course, they have that Nelson Peltz activist battle behind them that has served as a big overhang, a big distraction for the stock. So I think looking ahead, they are in a pretty solid position, especially when you compare it to where the company was about a year ago.
Ali, you're in store for one more question
yes.
here. Anything on earnings? We're just waiting for some results to come in, but any other trends that you've noticed in earnings that you'd like to tell viewers about?
I would say, the stock buyback story is a big one. Share repurchasing programs, dividend boosts. That's something that we've seen.
The buybacks are huge.
Huge, and something that we've seen from a lot of companies, a lot of tech giants really committing to that as well. And that points to sort of the underlying health that a lot of these companies are seeing. Of course, in tech, that a big boom there has been with the AI trade, and I'm sure that's only going to continue. But that's something that certainly stuck out to me this earnings season, just the fact that we saw these buybacks and dividend boosts really across the board.
Shareholder value, get ready to increase.
All right, let's get to some Lyft earnings, Jared, which are just breaking right now. It looks like we've got Q1 loss per share of 8 cents. I see clocking. I'm still looking for a comparable there, Jared. I do see, though, Q1 revenue, $1.28 billion. That is better than expected. The street was at $1.17 billion. Gross bookings, $3.69 billion. That is also better than expected. The street was at $3.59 billion. Active riders, 21.9 million versus 21.76 million. Looking ahead, let's look at their what they're seeing for Q2. It looks like they're looking for Q2 gross bookings of about $4 billion to $4.1 billion. Street was at $4.02 billion, and they're looking for 2Q adjusted EBITDA, $95 million to $100 million. The estimate was at $85.2 million.
Yep.
And you can see that stock shooting higher now in the after hours, Jared.
Yeah, I think it's all about that, what they consider profits, adjusted EBITDA. Gross bookings just taking a backseat. That was relatively in line to just a little bit down. So second quarter forecast really about the expectations of profit here. And just looking at some other points in the report, they're now seeing at least 70% of adjusted EBITDA being able to convert to free cash flow for 2024. That's key to operations. And they're also saying they remain on track to generate positive free cash flow for the full year. So, Lyft has been kind of playing second fiddle to Uber for a number of years, ever since they both IPO'd in the same year, going back at the beginning of the pandemic. And Uber is just that huge juggernaut of a company, but Lyft remains the pure play, the pure rideshare play. And it looks like it's up 3.6% right now. So earning reaction is actually itself very, very volatile.
And by the way, Uber, which reports tomorrow, looks like maybe rising in sympathy here in the after hours. Jared, Uber is up about 2% as well. And it's interesting because when analysts talk about that, you'll hear folks say, when talking about Lyft specifically, they'll talk about, some of them really like the kind of operational execution and efficiency that they've seen under CEO David Risher, who took over about a year ago. The key question for this name really comes down to the company's ability to kind of ramp profitability here. We've got a smart analyst coming up to talk more about this.
All right, and we also have Twilio earnings for the first quarter, and let's take a look at some of the numbers here for the first quarter. Now, these are the results. Adjusted EPS, 80 cents versus an estimate of 60 cents, so pretty big beat there. 47 cents was a year ago number. Revenue, $1.05 billion, just slightly topping estimates. That's a 4% year over year. And here's the forecast. Here's what the company is giving guidance for. They're seeing revenue of $1.05 to $1.06 billion, a little bit light of the $1.08 billion that was expected by the street. Adjusted EPS 64 to 68 cents. The estimate was for 65 cents, so a little bit of a beat there if you take the midpoint of their range. Seeing organic revenue up 4 to 5%, and then we have the year forecast. They're seeing adjusted operating income of $585 million to $635 million. I don't have a comp there, but you are seeing seeing the shares down about 4% in after-hours trading, and it might just be that that revenue number was not that big of a beat. First quarter results, the profit did handily beat expectations, but when you look at the revenue expected in the second quarter, that was just a little bit light of expectations.
Yeah, the stock, so, heading into this print, the stock was already down about 15% this year. Now we're down about 4% here in the after hours. Listen, a company that's best known for that kind of core messaging business. You do have a fairly new CEO here. He took over from co-founder Jeff Lawson. That was back in January. Taking over, we know, as the company's kind of faced this activist pressure, really. They want changes. They want better financial performance out of this company. And the company has been making changes, citing, they've been cutting costs, expanding capital return program. At least initially, though, reaction to this report here, down about 5% here in the after hours, Jared.
Yep. And also want to mention that rideshare company Lyft stock that is jumping after beating expectations for gross booking in its first quarter. And we're taking a closer look at the numbers with an analyst on the other side here.
Reddit reporting results here. Let's get those numbers. That stock is soaring here. It looks like, Jared, Q1 net loss, $575.1 million. The losses that were expected were $612.9 million, so not as bad there. It looks like Q1 revenue, Jared, coming in at $243 million. That also looks better than expected.
That's much better.
As for the outlook, that they are looking for Q2 revenue 240 to 255 million. The street was closer to 228 million, so much better than expected as well. Not surprised. You see the stock roaring higher in the after hours here.
Yep, you take a look at daily active users, 82.7 million, estimate 77.35. So just really blowing it out of the park on a number of fronts here. This is the company's first earnings, and I think maybe fitting that 3 years after GameStop, after that original phenomenon, that we finally see Reddit come to market and report earnings for the first time.
Yep, and we have an analyst coming up later to chat about that more. We'll get to that. Let's get to Lyft, though. They are higher here in the after hours. We're up about 3% right now. It's after the rideshare company reported its first quarter results. Here to discuss further is Tom White, D.A. Davidson, Senior Research Analyst. So, Tom, it's good to see you. Lyft reports the stock is higher here initially. At least investors seem to like what they see, Tom. But let's get your reaction. What's your response to what you're seeing?
Yeah, first off, thanks for having me. Yeah, look, we're not surprised to see the stock up a bit on the print, particularly given the fact that Lyft shares were down about 5% today. We think maybe that had a little bit to do with the Uber Instacart kind of partnership news that hit earlier this morning. But yeah, look, the Lyft quarter was strong, particularly on the top line. You know, the gross bookings came in above the high end of the range. And, you know, all the way kind of down the P&L, you saw some upside to what people were expecting. Second quarter guide was also a bit better, too. They largely affirmed the outlook for the full year, so they haven't really kind of taken up their expectations for the full year on kind of revenue and EBITDA. A little bit better free cash flow conversion. They kind of upgraded the outlook a little bit on that. But yeah, you know, generally a strong quarter shows that this company, continues to make solid kind of executional and operational improvements under their relatively new-ish CEO. I guess he's not that new at this point. It's been at least a year or so, but yeah.
Hey, Tom, anything in this report to get you excited about the stock, maybe take a bullish view of it? Could it be maybe next quarter expanding that full year view, getting a little bit more aggressive there in terms of setting up expectations?
Yeah, look, I think the main thing that we're interested in tracking is just their market share, their category share here in the domestic rideshare space. This is a company that at the time of their IPO, kind of pre-pandemic, had significantly higher share, category share and market share than it does now. It was gaining share also, and then the pandemic really kind of negatively impacted that trajectory. And so we're seeing Lyft kind of recapture some share. Part of that is due to some lower pricing that David Risher, the CEO, kind of implemented when he assumed the reins. But we're just trying to get a sense of whether or not these share gains are really sustainable, or is this just kind of an inevitable kind of bit of recovery from a relatively depressed level of category share, and it's going to be hard for them to kind of meaningfully get to where they were maybe pre-pandemic.
I'm interested, Tom, because you mentioned CEO David Risher, and he has been at the helm for about a year now. And I'm just interested, as financial analyst, Tom, you know the company backwards and forwards. What do you make of the job he's done, Tom? What grade would you give him?
Yeah, look, it's hard not to give him a good grade. B plus or above. The numbers pretty much speak for themselves. You've had here, I think 4 straight quarters of kind of accelerating growth on the rides front. Very prudent and disciplined around operating expenses. We had our first quarter of free cash flow positivity in some time last quarter. And so, he's doing a good job. Again, the business, I think, had some pretty glaring issues that it had to address when he got on board. So I don't want to say that it was sort of low-hanging fruit, some of the stuff that he's tackled. But he's got to keep it up here, I think, for the stock to probably get a meaningful leg up from where it is now.
And Tom, let's push ahead because Uber, of course, reporting results tomorrow, Tom. It's another company, your coverage universe. What are you looking for there?
Yeah, look, we expect a strong quarter from Uber. We think the core ride-sharing business, continues to grow at a healthy clip, and we're really starting to see the kind of the EBITDA flow through and the free cash flow generation potential of that large and dominant kind of rideshare platform in the vast majorities of the countries they're in. Delivery, that's all about kind of TAM expansion and entering new categories, getting bigger in some of the categories that they've kind of been in for a little bit longer. And then you've got kind of like new growth unlocks here that have emerged over the last quarter or two, things like advertising, things like Uber Reserve, some of the new mobility products, which we think all kind of create a bunch of interesting tailwinds here for that stock over the next 12 to 18 months.
Yeah, and I want to get you on that question, Tom, because I know you're a believer in Uber, you're a buy. What do you see as the catalyst ahead?
Yeah, I think delivery, making more concrete progress and sharing results of some of the momentum they have in delivery outside of the core restaurant vertical. I think that's something that investors are excited about. Again, the total addressable market for rideshare, I don't want to say it looks kind of capped here, but I think investors have a general idea of maybe how big that market can be over time. With delivery, it feels a lot more wide open, right? There are a lot more new categories, verticals that can be entered. You've got kind of sweeteners to growth on that business also in areas like advertising. So, I think progress on the new delivery verticals is probably the top one, and then momentum on some of these newer mobility formats, things like Uber Reserve, things like hailables, are the main catalysts I'd point to.
Got to leave it there. Tom White, D.A. Davidson, thank you so much. So much. All right, let's get you up to speed now in today's action, sponsored by Tasty Trade and a mixed day. Nasdaq down 10 basis points, S&P 500 up a little bit more than the inverse of that, 13 basis points. Dow Jones up 0.8%, and the Russell 2000 not shown, up about 0.2%.
And time now for What to Watch Wednesday, May 8th. Starting off on the earnings front, we'll be getting a new batch of earnings tomorrow, including Toyota, Uber, and Affirm. Uber announcing first quarter results before the bell. Analysts expect another strong quarter from the rideshare company, getting a lift from trips growth. Another element analysts will be looking out for on the call is the company's efforts to expand driver supply.
And sticking with earnings, we're going to see more results from Airbnb, Shopify, Robinhood, among others. Airbnb reporting first quarter earnings after the close. Now, the company expected to get a boost in room night growth from the Olympics this summer, but analysts are still forecasting revenue pressure from lower occupancy rates.
And finally, taking a look at the Fed, we're going to be hearing from another round of Fed commentary tomorrow from Fed Vice Chair Philip Jefferson, Boston Fed President Susan Collins, and Fed Governor Lisa Cook. This comes after Minneapolis Fed President Neil Kashkari's comments today saying that the central bank will likely keep interest rates where they are, quote, for an extended period of time. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Stay tuned for more Yahoo Finance on the other side.
right, the great reinvention of Whole Foods under the umbrella of Amazon continues. Let's talk to Whole Foods CEO Jason Beekle. Jason, it feels like we were just here. So now you're, what, a year into this job?
Yeah, about a year and a half.
How's the role going, and what is the state of Whole Foods inside Amazon?
Yeah, everything from my perspective is going great. Last January, we unveiled our 10-year vision, Growing with Purpose. And a big part is reconnecting to our higher purpose, our core values, and igniting our entire team member base around our important growth plan in serving our customers in more ways, expanding our reach and our impact, and ultimately finding ways by which we can nourish people on the planet, which is our higher purpose.
Let's talk about those customers. We hear so much about inflation. What's causing this down the grocery aisles, and is there any relief in sight?
Yeah, I mean, this has obviously been on the minds of many customers for a while now. One of the things that we've been doing is working with all of our suppliers to find ways to minimize this impact. The reality, though, is between commodities, labor costs, inflation has been real. And so one of the things that we've been trying to work through is minimizing this impact for customers. And there's a number of ways that we've been doing this. One, we've increased the number of promotions for our customers. And as a result, we've actually seen double-digit unit growth in promotional items. And that's customers telling us that value is really important for them. We've also been putting some price investments, especially for our 365 items and some of our opening
That's the private
price
label?
point items. Yes, exactly. 365s being our private label. And why this is important is making sure that our customers can shop any part of the store and we can make it accessible. And no matter what budget you're on, you can create a great meal on products that we carry, and on top of it, the quality is going to be best in class.
Do you get the sense that a lot of your suppliers or the companies that sell into Whole Foods, they're getting it? We have seen a pushback to these higher prices over the past 2 quarters. Do you get the sense they're willing to push back some prices in coming quarters?
Yeah, and we've been having conversations to understand what are some of the ways that we can help meet customers' needs. And I think one of the challenges we have here is customers want value, but they also want quality. And they care about how the product was grown or raised and how it's been produced. And so there's costs that come with that. So I think part of what we need to do is make sure that we can find a point where customers are happy with the value of the product and can appreciate the work that's gone into it at the same time.
Are Whole Foods sales and profits growing?
We actually don't share that publicly, but I can say we're really proud of how the business has been growing.
You know I'm a Whole Foods shopper. I'm a Friday $1 oyster loyalist, but I'm also an avid shopper in the prepared food section. Has that come back after the pandemic?
Yeah, it has, but in different forms. When we think about pre-pandemic, a lot of folks are in the office 5 days a week. They're popping in the store, shopping the salad bar, and now we're in a world where customers are in a much more hybrid state. So they're in the office a little bit, they're working from home, they're on the go, and so what customers are buying is different in that space. So we're seeing pre-pack being a much bigger part of that business than what it was before the pandemic.
How aggressive is Whole Foods in terms of opening new stores?
This is one area I'm really proud of. If you look at the last couple of years, our store growth has been in the single digits. We have now brought our stores in development up to 75, and our goal is to open 30 plus stores a year. And again, from being single digits to that's an expansive growth plan that we've taken on. And we're really excited about it because one, we've got a lot of customer interest, a lot of communities that are looking for us to bring new stores. And I'm excited because we're going to be bringing new formats in that as well. A perfect example of that is we just announced in March Whole Foods Market Daily Shop. So this is a smaller Whole Foods Market. Our very first store will be opening in the Upper East Side in Manhattan. And this is going to allow us to open stores where today we can't fit another full physical core Whole Foods Market store. And so this will be an opportunity for us to serve customers in a new way. And I think this would be a great opportunity, especially for fill-in shops for customers. So, as an example, for this new store, you might shop once a week at our Upper East Side flagship store, if you will, and you might pop into the Daily Shop 1 or 2 or 3 times a week as a customer. And so for us, this is going to allow us to better meet customers' needs, especially for those who are on the go.
We've seen Amazon test various concepts of its grocery. I was thinking back to the convenience store. You walk in, take something off the shelf, and you walk out. I don't have to interact with a cashier. Is that day ever coming to Whole Foods?
Yeah, I think we're working on more and more ways to make seamless checkout. One of the exciting areas we have right now is dash carts. And so this is a project we've worked on with Amazon. And so these are carts that you can walk through the store and check out as you're actually shopping.
Those are in store now?
Yes, we have those in several stores right now. Our San Mateo store has been our most recent launch here in California. And what's great is it weighs items for you. You're bagging your items as you go through the store, and you just walk through a special lane on the way out, and you're good to go. And so I think this will be ways by which we can help simplify the customer experience and use technology to create a more engaging experience at the same time.
I'm an avid user of the pay with your palm. I mean, it just works. I don't have to reach into my pocket and pull out my debit card. But is that the way you're thinking about technology inside of Whole Foods? It's making things simple. It's not a wholesale reinvention.
Yeah, Amazon One is also one of my favorite technologies we've implemented. It's now in all of our U.S. stores, and I've had so many customers share, like, not only one, they love how magical it is, but it saves time. You're not having to pull out, your phone, scanning a QR code to identify as Prime, and having to pull out a credit card. And so one of the things that we want to do is be able to use technology to simplify how we run our business. So for our team members, it's helping, take away some of those administrative, tactical, time that they're spending that's not adding value for our customers, and reinvesting it. So when you're going to our seafood counter, we can engage with you and help make that selection of what you're looking for dinner that night, or help shuck your oysters. And at the same time, for customers, providing digital experiences that can help you plan your visits to our stores, help you support your shopping trip while you're in our stores, whether it's locating an item, helping figure out a pairing, or through our checkout process, just making things more streamlined. So I think there's going to be a lot of ways by which we're going to partner with Amazon to deliver a great customer and team member experience through technology.
I'm a transparent guy. I told you off camera, every Friday I go get my oysters. I'm in Whole Foods a lot during the week. And we've built up a great relationship with the people in the fish department. And now they are blossoming and opening up new Whole Foods locations. It's amazing to see. Does that apply to other parts of the organization? I mean, are you now using your labor to promote from within? And a great example is Chipotle. People that started on that front line making burritos are now running 5 or 6 restaurants.
Yeah. That's one of the things I'm so proud of being part of Whole Foods Market. Investing in team member growth and happiness is one of our key priorities within Growing with Purpose. And for us, being able to promote from within and create a long career for our team members that is enriching is such a key priority for us. And we have countless examples of our team members who've started out as part-time team members, become store team leaders, become operational leadership. And, I have 2 direct reports right now that started out as part-time team members in our stores. And so one of the things that we've been doing is investing in growth initiatives and development initiatives for our team members to help them develop the skills for them to take the next step up. And one of those we call is our CD, or career development programs. And there's nothing like it I've seen in any other retailer. And so for all levels of our leadership at the store level, we have one of these programs, and it provides a safe and supportive environment for a team member to work side by side with a peer training in that role, and being able to take that next step either in that store or another store, or helping support them to the next level of leadership. And so there's countless of opportunities that you have within the company, whether it's at our stores or one of our support offices.
Real quickly, last year when we spoke briefly here, we were just starting out as the CEO of Whole Foods. You gave me a good undiscovered food gem. I think it was some form of hot sauce that I put on my oyster. Do you have a new one for me?
Yeah, I mean, one of the things I would ask you to look at is look for some of the regenerative products that we have in our store. We were the first retailer to launch private label products that are regenerative organic certified. We've got some dried mangoes right now, Whole Foods Market branded. They're outstanding. If you like lentils, we've also got some varietals of those as well. But keep an eye out for those, because they're going to be some of the best products we've got on our shelves.
All right, easy sell. Whole Foods CEO Jason Beagle, good to see you again. We appreciate it.
Yeah, thanks so much for having me. Really appreciate it.
Reddit shares are soaring right now in the after hours. It's after the company posted its first earnings report since going public. And joining us now to break down those numbers is Rohit Kulkarni, Roth MKM Managing Director. Rohit, it is always great to have you on the show. So listen, Reddit reports the stock is up about 16% right now in the after hours. So Rohit, just give us your reaction. What'd you make of this report?
Hey, thanks for having me, Josh. I think, again, every first earnings for an IPO company, there is going to be conservatism baked into expectations. And there was conservative. We were conservative. We thought they would have a nice little beat and raise. But looking at numbers, these numbers are very, very impressive. I think the amount of users that they are adding, the revenue growth acceleration that they are showing, and profitability that's coming as a result of all of this, that's even above the most optimistic expectations that we had heard over the last 3-4 weeks. So I think all in all, it's a fundamentally very solid quarter. They're executing well, and they're on their way to profitability much sooner than expected. So the stock reaction is not completely unwarranted, in my opinion.
Yes, I remember around the IPO when it was first listing, there were concerns that it really hadn't pursued monetization aggressively or seriously. Does it seem now maybe to investors that now they are on track and at least tackling the issue of monetization? Do you think we're going to get more specific plans, something that investors have wanted to see?
Yeah, I think so too. As in this company, we have followed this company as a private one for a number of years, and this is one of those cases where a 10 or 15-year-old company almost didn't plan to commercialize its activities for the first 10 years of its existence. And all the commercial activities that they have done have happened in the last 3-4 years. And by that, what I'm saying is they're very, very early with monetization. They have a lot of low-hanging fruit to just clean up their ads manager, clean up their ad tech, and put ads in the right ads in the front of right people at the right time. So all of those things are just coming together slowly. It would be a multi-quarter process, but what we are seeing right now is a right step in monetization, and we are confident that there are several revenue catalysts ahead. And again, the users, I think, just to go back to that point, that's the best leading indicator for any social media platform, and they're adding users at a faster clip than what we have seen in any other platform. So we like what you're seeing here, and would be buyers on this strength.
Rohit, what about this other opportunity Reddit clearly sees, licensing data to other firms to train their AI models? Rohit, how much of an opportunity do you see that as?
I would say this is over the longer term, probably maybe 20 to 25% of the revenues would come from data licensing. Again, there are a lot of variables going forward, but having said that, I think given the wave that they're going to be riding, Reddit has probably the best kind of corpus of internet data that is in text format, and that has a lot of unique signals of intent to brands. So unlike Twitter, unlike Pinterest, which have some different signals, Reddit has a very unique corpus of data, and that data becomes more valuable as all these companies that are building large language models need some new data, fresh data, accurate data with signals to train on. So I like that as an opportunity, but I think it's still very early to say how large it could be. We model somewhere in the range of $80 to $90 million of annual run rate revenues by end of this year, which is probably lower than some of the people on the street, and it kind of grows 20-30% year on year going forward. So we shall see how that grows, but I think it's a sizable, chunky business in 3 to 4 years.
I want to ask you about the board of directors there. Reddit just announced the addition of Sarah Farrell. She's joining the board of directors here. What can you say about her? What does this make sense, or why does this make sense for the company?
That to me was a surprise, as in, again, to add somebody on the board so early, so soon, after a fairly elaborate IPO process, that to me is a surprise. In terms of what Sarah can add to the board, probably kind of a new sense of fiscal prudence, a new sense of kind of economic kind of discipline that this company may lack in some angles. But I think that's to me it was a surprise, and we would be learning more about the who and why and what behind this move at the end of the earnings call as such.
Rohit, I'm just curious. Do we have any kind of line of sight as to who the Reddit user is? I always assumed, Rohit, it would be kind of relatively older, only because it's text based, and the kids are on TikTok making videos, Rohit. But maybe I'm wrong. Have you seen any data in terms of the demo here?
We have seen some data in the demo, and I think Reddit user tends to skew slightly older than Instagram user. Obviously, they have the greatest number of overlap with Facebook, Instagram, least overlap with Snapchat and LinkedIn and Pinterest, for example. So in terms of more overlap, it's obviously more towards Facebook, Instagram, and less towards Snap and Pinterest. But also, given the way the usage is, we also think that they have more users than a Pinterest and a Twitter in terms of kind of daily active uniques on each of those platforms. So that's a very compelling kind of value prop. More users than Pinterest and Twitter on a daily usage perspective, and so that means there is a greater opportunity for them to do monetization. But to answer your question more directly, they have a greater overlap with Facebook and much less than Snap, Pins, and Twitch.
Rohit, always love having you on the show. Thank you, my friend, for joining us.
Thank you so much.
Shares of Kyndryl jumping after the IT services company posted better than expected top-line results for its fiscal fourth quarter. The company's revenue topped expectations at $3.8 billion. The loss per share was wider than analysts had anticipated. The company has been working to reach consistent profitability since it spun off from IBM in 2021. Here to discuss is Kyndryl CEO Martin Schroeter. Martin, it is good to see you. So you reported investors seem to like what you had to say, Martin. This stock is popping about 6% right now in the after hours. Maybe start there, Martin. Just walk us through what drove the quarter.
Yeah, thanks, Josh, and we appreciate the opportunity. Look, we finished a great quarter, which was the end of a terrific year for us. One where the investments we're making in our skills, the investments that we're making in our Kyndryl Bridge platform, which helps us deliver insights to our customers, and the alliance network that we've built to really become part of the ecosystem that matters is really what's driving our return to growth. And we were able, in our guidance now, we were able to talk about revenue growth in the first calendar quarter of next year, which is our fourth fiscal quarter of this year. So we're getting back to growth faster based on the strength we see in our alliance activity. We're getting back to growth faster based on the strength we see in our Kyndryl Consult business. And again, driven by the investments we've been making paying off.
You mentioned your alliance network. I just wanted to touch on that. How important are these big hyperscalers to your business, and what's your plan for them going forward?
Yeah, it's a great question. Look, one of the things that we didn't have as part of IBM was a freedom of action to partner with the ecosystem that matters. And the first thing we did was take advantage of that freedom of action 2.5 years ago when we spun out, and we created really deep, meaningful relationships with Microsoft and Google and AWS and Oracle and SAP and others. And we've been evolving those as well. So yes, we certainly created a deep and meaningful partnership with Microsoft a week after we were spun out, and that's now evolved to help our joint customers, Microsoft Kyndryl joint customers, on, for instance, their Gen AI journeys. And so in just 2.5 years, the year we just finished, we've already created a $500 million revenue stream of our services around what the hyperscalers are doing on their cloud platforms. And we would expect that that'll be close to $1 billion this year alone. And it gives you a sense of the role we play in our customers' infrastructures and how important we are. Gives you a sense of how keen the tech players who matter are to work with us, and it gives you a sense of how much our customers trust us on their journeys as we start to, again, build a pretty substantial business with these important partners. But they are vital to us. They've been a great part of our turnaround story, and we expect that to continue.
And Martin, I'm interested as enterprises now work hard to modernize their infrastructures for AI deployments. Martin, I'm curious what you think that's going to mean for your business.
Yeah, AI is both a way we run our business. Our AI, our machine learning sits at the heart of how we deliver our services. It's what allows us to automate things on behalf of our customers to deliver very, very high quality. It's also what allows us to give 3 million actionable insights every month to our customer base so they can get ahead of problems, they can optimize, they can take advantage of the technologies they see. At the same time, AI and Gen AI in particular is a revenue opportunity for us because the first steps, and our customers know this, everybody knows that the first steps you have to take in order to really use Gen AI is to get your data architected in the right way, to take advantage of all your data, and then to make sure, again, we run mission critical. So if you were to put Gen AI into a workflow, if you were to put Gen AI into the middle of a run system that is mission critical, you better make sure you understand the security characteristics, that it has the resiliency that you need, that you can answer regulators' questions. So for us, AI sits at the heart of how we do what we do, but it also represents a really a growing consult opportunity for us as we help our customers think about how to get ready.
We're going to have to leave it there, but really appreciate you appearing on your earnings day. Martin Schroeder, Kyndryl CEO.
Thank you.
Occidental Petroleum shares slightly lower after reporting first quarter results. We have Yahoo Finance's Ines Ferre to break down the numbers. Ines, what do you see?
Yeah, Jared. So Occidental beating on the bottom line, coming in better than expected with its earnings. The revenue, though, came in lighter than expected. Part of this has to do with lower oil prices, also production volumes, which weighed on the results. So you can see the results there. Adjusted earnings per share coming in at 63 cents, better than what the street had been expecting. As far as the guidance is concerned, the company is reaffirming its full year production guidance. As far as total production for the quarter, total production averaged near the midpoint range. And that in part is because of an outage, a third-party outage in the eastern Gulf of Mexico. Now, Occidental had already warned about this. There was some pipeline testing that was going on, and production in that region resumed in mid-April. Something interesting from these results, OxyChem, their chemical business, that came in, that topped expectations. And as far as Occidental's acquisition of Crown Rock, that acquisition is expected, that deal is expected to close in the third quarter of this year. That's a $12 billion deal. It's a little bit different because it involves debt, and also it's a private company that they're acquiring, guys.
Inez, thanks so much. Appreciate it. Coming up, Rivian shares are slipping here after the company reported earnings. We're going to get you those numbers on the other side. Rivian shares sliding after the EV maker delivers its first quarter results. Praz Subramanian joins us now with Praz.
Yeah, a little slight revenue beat here, but a wider than expected loss hitting shares in the aftermarket. Also want to note that they did reaffirm that they're going to hit their adjusted EBITDA loss for the quarter, not great, but they trimmed their CapEx spend from to 1.2 billion from 1.75 because of the fact that they're going to move their R2 production from the proposed site in Georgia to their existing plant in Normal. They're going to see some cost efficiencies there. They're going to delay that plant in Georgia, so to delay some of that spending. That's good. They also still see a modest gross profit in Q4 for their vehicle, so that's also positive. But I guess investors not liking that wider than expected loss right now.
Yeah. I mean, it's interesting, Price, because you think of this company, this is a pure EV play.
Yeah.
So on the one hand, they got to deal with EV growth that isn't what it once was. And on the other hand, if you were looking ahead, the R2, that's not coming out till, what is that, 26?
2026, early 2026. So we still have at least another year and a half before we see that vehicle. And I think there's a lot of these sort of bets in the company are based on that car, the mid 40s, $45,000 starting price, which is a great place to be for an EV, and that's competing square on with Tesla's Model Y, and it has a bit more cachet.
Yeah.
But the problem is, can they wait that long? Can they get there?
Or do you have to start, or do they have to think about raise more money?
Raise more money, or I mean, can they push up production? That's also a big question. They're retooling the plant in Normal, Illinois, but can you get that car out here faster? And the problem is you got to set up the whole supply chain for that. That's an issue, and I think that's the concern now for Rivian.
Yep, Praz, thank you, buddy. Appreciate it. That's going to do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.